Hi, this is Cayden from VIA Value Investing Academy. Now, I'm quite sure you have watched a trailer clip, right? Which is created by Netflix. Now, just to double check whether you are able to hear my voice, right, and see my share screen. Now, I already shared screen right now, and you should be able to see a screenshot, right, of Netflix YouTube channel, and there are 23.3 million subscribers. Well, that's really a lot. Yeah, for us at VIA, we have just crossed about 5,000. Yeah, 5,000 subscribers. Yay! Susie very happy, huh? So our goal is to turn from 5,000 to 23 million. Okay, this one maybe take 23 years, but yeah. Okay, so just to double check if you can hear me and see my share screen, right? Can you just type yes so that I know? There you can see we have about 98 people watching this live chat. Yeah, I think yes, you can see and hear. Okay, thank you, Angeline. So let's get started, right? By the way, I just want to thank Netflix for putting up the trailer clip via YouTube so that we can play all the official trailers. Just to let you know that all the intellectual property, right, belongs to Netflix. And then by playing their trailer, I don't get a cut in case you subscribe. So I like to give full credit to Netflix. Yeah, so let's get started, right? I mean Netflix, so what has it got to do with our deep dive this evening? Before we go into the Netflix part, just to let you know that for a couple of weeks, there has been quite a number of news talking about incoming, impending US recession. And if you look at this article, it's by the Fed, right? The Fed has made a US recession inevitable. Yeah, so this is a very interesting thing. And then there's another article that said we are nearing a recession. Yeah, if this always accurate indicator is right again. So in this case, there is this word, right, indicator. If this indicator is right, then we are very close to a recession. And if you look at the article, right, it's actually published on the 29th of March 2022, so it's really very recent. So what is this recession and this Netflix, and how are they related together, right? Because tonight, we're going to talk about one keyword, and this keyword is crash. Crash, it's a favorite word that Hawk, right? Hawk is smash, but it's okay, smash and crash. So the keyword for tonight is actually about crash. Why, right? Because the share price of Netflix has indeed crashed, and then the Fed is talking about a possible recession, and that may result in the stock market crash. So tonight there are two parts to it. The first part, we're going to talk about this stock price, right? The crash of the stock price of Netflix, and the other one we're going to talk about the recession, which is quite interesting. And every time whenever there's a crash, there's a recession, and so on, it really creates opportunities for value investors, because through our eyes, every trouble, right, is an investment opportunity. So tonight's session, there'll be two parts: Netflix with a very short break, then followed by the stock market crash. Now, and of course, for the second part, I'll talk about three very important economic indicators that really give some telltale sign that there is a upcoming recession. So just hang on there. So we have about 121 people watching this. So the first part, we're going to talk about the crash of the Netflix stock price. Now, if you look at the most recent high of Netflix, the share price is about $691 US, and indeed it has crashed, crashed about 50%. Yeah, to about the most recent price, about 359. So it's about 50%. Now 50%, if it's not Netflix, if it's S&P 500, it's actually a recession. So in other words, instead of a global recession, it's actually the recession, right, on Netflix. So now the question is, if the price has fallen, if the price has gone the other way around, is Netflix a good buy after the plunge? Now, before we deep dive right into Netflix and all the details, fundamentals, and so on, yeah, okay, I'm going to talk about this disclaimer, right? So maybe I just jump straight to the second paragraph, paragraph, right? Now, so remember this disclaimer: in no event shall VIA, me, or Hillary, right, who will be sharing with you tonight, be liable to any one of you, 124 of you, a guested party for any damages of any kind arising out of the use of any content shared here. Remember, this is just for education, for fun, right? Remember, including without limitation the use of such content outside its intended purpose of investor education. And remember, any investment losses, lost profit, lost opportunity, special, incidental, indirect, consequential, or punitive damages resulting from such unintended use. So remember, neither My Kinesis Investments Private Limited, VIA, nor author, which is me and Hillary, right, All of the case studies are operated by or affiliated with any broker, dealer or licensed advisor. In short, we are not licensed by AMS to say, hey, you buy, you sell, cannot, huh? But we want to educate you, okay? So remember, past performance is a poor indicator of future performance. Again, the information of this presentation is not intended to be, right? Nor does it constitute any form of investment advice or recommendation. Okay, so I'm done. So I've covered 50%, right? So let's go deep dive into Netflix. By the way, before I start, I just want to let you know that I'm like a movie goer, right? Because of the nature of my job that requires me to speak, I like to involve myself in any activity, right, that doesn't require me to open my mouth. Yeah, so watching movie is really the best, huh? Because training are to entertain people, right? So movies, I'm being entertained. So I'm really like a staunch fan of movies. Yeah, so right now Netflix, I think it's pretty good, huh? So in case you thought that Netflix is just watching movie and so on, if we really go deep dive, actually there are a lot of small little intricacies, right? Yeah, then eventually by the end of this session, you will fully appreciate how Netflix, right, really make money by entertaining you. Okay, so let's get started, right? In case some of you are not our graduates, you have not invested before. Now, just to let you know that investment is not about like watching a YouTube like hours and then suddenly, oh, you go and buy or follow some influencer or TikToker. Now, remember, our intention for tonight is really to provide education, and we also want to give you a rough structure, right? Before you show hand your hard-earned money into something, you better know what it is all about. So the first one, we better know what is Netflix all about. Now, these are some of the information that you may know. Point number one, right? Netflix, they provide streaming services. Yeah, and they also have their original Netflix movie, right? So in other words, they stream their movies, shows, documentary, and so on, right? But they are also a film production company. Yeah, they had to produce film before they can stream, right? Yeah. So now the key thing is you must understand that if you subscribe to Netflix, you realize that not all their shows are produced by Netflix themselves. For example, when I subscribe to Netflix, there is Spider-Man, right? Yeah, Spider-Man is not produced by Netflix. So now you may notice if you are a subscriber, you may notice that their movies, documentaries consist of a few types of content. Now, so one of the type of content, right, is they get it from someone. They acquire from someone. For example, the Spider-Man, they don't produce it, but they acquire from someone. So in other words, that someone, Sony or whatever, right, give them the license, give them the rights for them to stream, right, to play, to show this movie via their Netflix platform. Yeah, so this is the first type of content. They acquire the license, okay, then they stream it. The other one, right, is they own self-produce, right, and then they own self-produce and then they stream it to you. So there are two parts to this, And this is just some pictures to show you some of the best dramas and so on. I'm not very sure whether can you recognize. Recently, this one become very popular, this young lady, right? Yeah, and then Michael Jordan, really tons of things. I think it's quite entertaining. They even have cartoon, cartoon, right, if you have children, So, of course, once they acquire the license, they stream the movies and then or they produce the movie themselves. In terms of the executional level, right, you can watch the movie on your PC browser, yeah, or laptop whatsoever, or you can watch it on a smartphone, tablet, a smart TV. Yeah, so for me, I can watch it on my phone and I can also watch it on my smart TV. So this is how they deliver, right, their entertainment to you. This is quite important, right? Now, then in terms of where they are, their HQ is in California. I don't know how to pronounce this, Los Gatos. And then, of course, they have international worldwide office. And remember, right, not only they acquire and then they get the license, they also produce the movie themselves. So these are the 5 locations where they produce their movies. Yeah. Now, this is very interesting, right? So in the next 1 minute, I'm going to show you how Netflix evolved. And in case some of you are business owners, self-employed, right? I think from that angle, you can also learn how a business really grow. And this is also something that I find very interesting, right? So Netflix wasn't really new. It was founded in 1997. Yeah, so it's quite been around. Then subsequently, they introduced monthly subscription. Now, if you look at, other than Netflix, if you look at video games, right? In the early days, video game, you play DVD, VCD, right? Yeah, so right now, you download for free, and then sometimes you have to pay some form of subscription. Yeah, so why subscription is important to a business? Because it's recurring. Otherwise, they have to continue to rent the DVD. I think it's a bit difficult. Yeah. Then they launched the IPO. And one of the reasons from an investor perspective, IPO stands for initial public offering. That means before this IPO, they are a private limited company. So what they did is they issue the shares, they sell the shares, right, at $15 per share, which means that if we travel back in time in 2002, if you have bought Netflix shares, this is of course on the high side, right? Yeah, today is 373, then your ROI is 2,386. Yeah, everybody will want to turn back time. Yeah, okay, huh? Then subsequently, they reached 1 million subscribers. For us, it's 5,000, but don't worry. Yeah, 20 years later, I also draw a VIA timeline. Okay, then it started from 0. Then when Suzy come in from 0 to 5,000, you know, along the line. Yeah, so these are some interesting, you know, streaming services. They expand, you know, platform and so on. Yeah, more and more movies, right? Then this one very interesting. This one they introduced a 4K Ultra HD. That means high res. High res. Yeah, then they further expand. Now, then of course, it's a chicken and egg thing, right? Once they acquire more content, produce more content, eventually the subscribers reach 100 million. And this one is most interesting. This one I only got to know recently, right? They launched mobile gaming, right, in 2021. Yeah, that was during a pandemic. So during pandemic, they launched mobile gaming. Okay, we'll talk about the gaming. It's quite interesting. Yeah, so we are transitioning right into the detail. So right now we have this like evolution of Netflix, right? So how do they make money? By providing entertainment. What kind of products do they provide? Now, so the first one, we're going to talk about the movies, things that we already know. Then I'm going to talk about things that we may not know. Now, so here, right, Netflix original. Now, so when we say Netflix original, what do we mean, right? It simply means that there are some shows where it's really produced by their own production house, such as this title over here. This is quite interesting, right? The Queen's Gambit. I think it showcased one young lady who is extremely good in chess game. I think so. Yeah, so it looks something like this. Yeah, I think recently I keep seeing this one, I think on TikTok or on Facebook. Yeah, so that's one. Now, then another one is, okay, other than they own self-produce and then they show, right? Yeah, another one is they buy from someone, they acquire. They acquire the rights for me to play, right? So that it's only played at my site and not like some form of exclusive license, right? So another example of a movie is called The Crown. Yeah, so remember, they produced themselves, they bought the right to exclusively play at my platform. So this one. Now, then this one is very interesting. This is on the left, right? This one is also something like getting the license to play this show. Except that this show it has been broadcast. That means it has been broadcast somewhere after the first run. Then they buy the rights to play the second run onwards. Yeah, onwards. Yeah, so in other words, it's a rerun. Rerun, right? Now, in case you do not know what I'm talking about, you just imagine, right? You know MediaCorp, you know Singapore's only TV broadcaster, right? Now, the MediaCorp is very good in doing rerun. Yeah, rerun. So if you turn on the TV, you always see the rerun. Some shows are very old, like Bruce Lee, Jackie Chan, all this. So they are expert in doing rerun. Yeah, so sometimes I don't know why MediaCorp still around. I think Netflix should kill MediaCorp. Okay, MediaCorp is like a rerun king. Okay, so some of the rerun, for example, Grey's Anatomy. So remember, original, they produce themselves, they acquire, play it for the first time. Then the other one is they play the rerun. Now, so that is the things that we know. And if you are a Singapore subscriber, right, you can see there are 3 plans. And of course, from a business perspective, you want to provide different tier, right? Yeah, different tier, right? Yeah, you know, something like McDonald's, do you want upsize? So all these are the upsize. Yeah, so initially I suspect they may start off at $12.98. Then they add more value, right? Then become 17. So this is how they can squeeze more money out doing almost the same thing. Yeah, so this is Singapore. Then, of course, the next one is the games. Now, it's only when Hillary did the research and then there's games. So then I took out my Netflix app and then I tried to explore the game. So let me just show you. Screenshot, right? So I double-click Netflix. This thing will pop out, right? Then I scroll, trying to look for the game. And you will see something over here. Can you see? This is the game. Yeah, it's so inconspicuous. I would have just scrolled past it. Yeah, scroll past it. So I'm curious, right? So I click on the game. So when I click, I scroll to the left, right? Wow, there are actually a lot, a lot, But the game looks very kiddish. Yeah, so I'm an adult. Why would I want to play this game, right? But I just want to explore what is it. So what I did was I clicked on this button, right? I randomly click on one game. Then there's this button get. So I click. I want to download, right? So I download. At first, after I download, right, I thought the game will be inside the Netflix. some button somewhere, right? So that when I click, I can play the game within the platform Netflix. But unfortunately, after I download, I couldn't find the game. Yeah, then I come to this place again. Then I have to download again, download. So in total, I did 5 times. 5 times. So after 5 times, it was totally not successful. Not successful, right? So I went to see some comment, right? See some comment. Okay, this game. Most interesting comment is here. Quite literally, the most pointless game that I ever played in my life. You can't even so there's a 1 star. So in short, I want to play a game, but it didn't happen. So I think Netflix, if you're watching this, right, I think you need to wake up your idea. Can you please fix your game? Yeah. So now the question is why, right? Yeah, why? You know, I'm a movie. I produce movie. I want to stream the movie. Why do I go into a game? So their primary intention is to keep the subscribers hooked. Now, whether it works or not, that's a separate thing. That is what they want to start, right? Launch right from the app. After downloading, it didn't work for me. Now, introducing more points of entry to its content, it doesn't make sense for me, right? Because if I want to play game in the first place, I wouldn't play the lousy game that they're introducing. So I find it very hard. How can that be entry point? So if they argue, right, they create additional entertainment for game, but I got other games to play. I can play Marvel games, right? Why would I play a silly game that can never be downloaded? Yeah, so this is what they want, but from a user perspective, I don't feel that they are achieving what they want. And by the way, just to let all of you know, right, in case you want to press button and buy Netflix, gaming is one of the biggest competitors of all time. So in other words, Netflix is not competing with another movie streaming service. In fact, they are competing with other people based on time. For example, right, if I'm a TikTok addict and every day I spend 5 hours, right? If 5 hours go to TikTok, unlikely I'm going to use these 5 hours to do Netflix at the same time, right? So in other words, so they are not really just competing on the video streaming service, but they're competing time with other form of entertainment. And there's one more thing. Let me just share with you, right? To produce a video game, it's not easy. For example, right, EA, right, Electronic Arts, has 11,000 employees just to produce games. And 11,000, right, they produce 30 billion worth of revenue of games. Netflix generate less than 10 billion. And remember, their employees is definitely less than 11K. Yeah, so imagine if Netflix want to go to the video game world, they want to compete with Electronic Arts. I think this is an uphill task. Yeah, so in terms of the game, at least from a user perspective and investment perspective, so far it hasn't made any sense yet. Made any sense yet. Yeah. So the next part, right, is some technical things about the revenue. So now we know what they do, the movie streaming, and then the game, right? So now the question is in terms of the amount of money, do they convert these subscribers to money? So I'm going to hand over to Hillary. Hillary did all this technical stuff, right? Yeah, so I think in the next couple of seconds, I'll just hand over to Hillary.
Hi, good evening, everyone. So right now it's my turn to share about Netflix on the technical terms. So first off, we'll see how they generate the revenue. So first off, since Cayden already shared, we know that Netflix makes movie, but actually how do they really generate the revenue and what type of sources of revenue streams do they generate? So first off, we can see that there's actually only 2 revenues stream that they are generating. One is from streaming and the other is from DVD revenues. So in fact, Netflix actually started from DVD. So this is kind of a legacy revenue stream from them. But this DVD revenue is only in US and it just contributed about 0.6%. So right now we only focus on the streaming revenues. Now we'll see from year on year, starting from 2017 until 2021, we can see that streaming revenues is actually increasing from 2017 until 2021, whereas DVD revenues are actually decreasing since then. So this shows that actually people are more and more going to watch their shows on live stream instead of renting DVDs to watch shows. Okay, next up, we wanted to know that from these revenues, where are these revenues actually coming from, which part of the world? So we can see that they are actually separate them into 4 main geographical regions: the US and Canada, Europe, Middle East and Africa, Latin America, and also Asia Pacific. And from here, we can see that a huge chunk of it is actually coming from the US and the Canada, which comprise about 44% of the whole pie chart. And it contributed about 13 billion of revenues from US region. Then followed by the Europe, Middle East, and Africa. So these are the 2 main regions where Netflix are generating their revenues from. So other than the revenue, we also look into the numbers of membership. Why? It's because we know that in order to generate the revenue, they need to have members to subscribe to the Netflix platform. So we will see that in 2021, there's about 221.8 million members. So where are they from? Which region? So we can see that from US and Canada and also Europe and Middle East and Africa, they made up about 34% of the whole pie chart each. So we can know that most of the subscribers are coming from these two main regions. And other than that, we also look into year on year, how does the membership actually grows. So we can see that from 2017 onwards, the total membership is actually growing from 110 million members until right now in 2021, about 222 million members. So this one is actually in accumulative. That means assuming that the retaining members still continue with the subscription, they still keep on adding on new members. So you can see at the bottom there, the blue boxes. You can see that from 2017 until 2019, they are growing consistently about 20 plus million. But from 2019 onwards, there was about 32% increment from 27.8 million until 36.6 million. However, in 2021, there's actually about 50% drop from 36.6 million to 18.2 million members. Even though there is a drop, but we can see that the total memberships year on year is still increasing. So what we wanted to see is that we wanted to see the members keep on increasing, right? Because when there's a lot more members who are subscribing, that means there are also members paying for the subscription fee. But if the trend that the new members adding on is getting lesser and lesser, this total membership curve will slowly flatten. And this is something that we do not want to see. Yeah. Okay, next. In order to retain the existing members and also add on to have more new members, what are the future plans that Netflix has in order to achieve this? So first off is that they wanted to increase more original content productions. Why? It's because they wanted to expand what they have. You can see on the diagram, on the graphic, these are the existing original Netflix shows that they already produced. But by producing more original content, they allow the consumers to choose and also can also entice more members to join and watch the show. So we can see that in 2021, in the top search shows for TV, among the top 10, 6 belongs to Netflix. And then in the movie category, 2 belongs to Netflix. So we can see that actually there are more demands from the consumers that they want to watch show on Netflix. Other than that, by producing their own content, they can also control the quality. So we can see that in the Oscar nominations from 2014 until 2021 is actually increasing. So by having these nominations, it actually kind of implies that the show that Netflix produce are getting better and better quality. So if let's say there's one show, there's 2 types of show. One show that is just a normal show, but another show that wants an Oscar nomination. Which show would you want to watch? You will tend to want to spend your time watch something that is of quality, right? Yeah. So other than that, in order to support this, to let them produce more original content, they have these 5 production hubs in the 5 cities. So the first one is in London, the second one is in Madrid, New York City, Toronto in Canada, and also one in New Mexico. So the reason why they have these different production hubs throughout different world is because, like for example, in Madrid, they can produce more original content that is Spanish speaking, that is related to their culture. Because the shows that is shown on Netflix, sometimes there's also geographical limitations. That means this show is only available in US or this show is only available in Singapore. So that is the reason why they have 5 production hubs in different cities. Yeah, exclusive to a region. Okay, so next is that another future plan is that they wanted to get into the gaming industry. So earlier on, Cayden has shared a bit about the game, but because they only started in 2021, so there might be a lot of kinks they need to iron out. So Cayden has played the devil, so I'll try to play the angel from this side to give you a much more fairer perspective. Okay, so what they did is that they acquired a gaming company because like earlier that Cayden shared that compared between EA and other gaming companies, they need a lot of employees to work on it. So in order to create a game, other than employees, they also need a lot of developers to make sure that the game is very enticing and people wanted to play. But since it spent a lot of time and also capital to do that, the fastest way is to acquire some gaming companies, which is what Netflix is doing. So in 2021, Netflix has acquired Night School Studio, Boss Fight Entertainment, and Next Game, which is currently still in discussion for acquiring. So Next Game is actually the creator for this Stranger Things. So if you have watched Netflix, you will realize that Stranger Things is actually one of the original series in Netflix. So why does Netflix wanted to get into the gaming industry? So actually in this article, the executive in Netflix actually explained that they wanted to extend what they have and harvest the data to find out what the consumers really like. And then from then they can create more. So another way we can see this is that they want to keep the consumers within the show universe. That means when you watch the show, you will tend to like the character, right? So if you have that game, you can spend more time to play the character, get to know them. And from there, when they gather the data, they will know that, okay, this is what the audiences like. So then they can produce related original content. So it kind of becomes a virtuous cycle. So this is what their intention is. But whether does it works out, we will have to see for the next few years to see if it really plays out. So this is the reason why there is no additional cost for you to play the game. Yeah, because they just want you to know that there's more things you can spend your time on Netflix. Okay, so next up, we wanted to know what are the advantages or maybe the moats that Netflix has over the competitors to make them become the leading this industry. So the first moat is the patents, is to protect their technology prowess. So why? So in 2021, we can see that the patents that they registered in the technology area is about 223. So why is this important? It's because they wanted to have the advantage to provide a top-notch streaming experience for their consumers. So maybe I can give an example for AI recommendation. So when you scroll through the Netflix, you will tend to like to watch certain shows like horror movies or maybe comedies. So after you watch a certain show, you will realize that some similar shows also showed up on your recommendations so that you don't have to scroll through the whole library, because right now Netflix has tons and tons of movies. So it's unlikely that one person will spend their time just to scroll through the library to watch what show. So based on the AI recommendations, some related shows will show up on your recommendation list, and it can cut down your time to find what show that you like to watch on. Like for example, I don't like horror, but they show me horror. It's it does not make sense for me. And then another thing is about broadcast licensing, right? So earlier on, Cayden has explained between what is a first run, second run, what is an owned, and also a license. So from here, we can see that Netflix wanted to increase more original content is because by producing their own original content, they own the licensing rights. So they can show the original contents on their platform anytime, anywhere, how they like. Like for example, earlier on when the trailer was showing, do you like to watch the shows? It's actually very attracting though. And the thing is that in order to watch this show, you can only watch it on Netflix. You cannot watch it on any other platforms. So other than that, if let's say you wanted to change to another streaming platform, but the other streaming platform might not be showing all these original series, so you might miss out some of the favorite shows should you change to another platform. So the switching cost for this is also quite high. Other than that, Netflix also provides many different methods for their members to watch their show throughout the different geographical regions, like for example, over the PC browsers or maybe the internet-connected device like smartphones, smart TVs, and even gaming consoles can also watch Netflix. So we can have a look at Philippines, because when you compare between Singapore and Philippines, Singapore has 3 tiers of pricing, but in Philippines, they have 4 tiers. So they include a mobile and a basic. So what is the difference? We can see that for mobile, they only able to watch shows on the mobile devices like smartphones or tablets on the go, but they cannot watch it on the PC or maybe TV. But if they sign up for the basic plan, they can still watch it on all these devices. So it depends on what does the consumer want and how much is their budget. Because some consumers, they might not be able to afford a slightly higher pricing, but they wanted to watch the show. By doing this, more people are able to subscribe to the Netflix platform. Okay, so other than that, we will show that who are the streaming company competitors for Netflix. So here I list out 4 of them. Amazon Prime Video, Disney Plus, HBO Max, and also Hulu. So when I was doing the research, I just realized that this is the first time I heard about Hulu. So what is Hulu? Okay, so first off, we look at the annual revenue for 2021. So among all, Netflix has the highest revenue at the moment. And subsequently, we also look at the total number of these subscribers. Netflix is also still taking the lead. And then it's the movie shows are all distributed throughout 190 countries. So earlier on, I mentioned that I only heard Hulu when I was doing this research is because it's only available in US. Yeah. Other than that, we also look into the monthly subscription fee. So Netflix has offered 3 different tiers, but other competitors, they offer 2. It's either with ads or without ads. And then we also look into whether do they offer like higher resolution. Most of them they offered, and how many screens for streaming, for simultaneous streaming. That means for one plan, how many screens, how many smartphones you can watch the show at the same time. So Netflix actually separate into 3 different types of availability, but other platforms, they like one lump to tell you that how many devices are available. And also, usually when you watch show, it's very irritating that's commercial, right? So most of them, they don't have, unless you choose a plan with an ad for HBO Max and also Hulu. And also, since Netflix started with their original productions, the other streaming platforms are also having their own original productions. Yeah, so in order to watch certain shows that you like, you have to go to that specific streaming platform to watch that. So what are the shows that they actually offered? So for Netflix, these are the shows, Amazon, and this, and then Disney, of course, Disney cartoons, and then HBO Max, and for Hulu. Yeah. So other than the streaming companies, earlier on, Cayden has mentioned that Netflix is also competing against other entertainment channels for the time, for the free time. Because, so this is known as winning moments of truth. In short, they define it as the consumers choose them over other entertainment sources to spend their free time. So what are the other competitors that Netflix has to compete against? One is social media, because like when you scroll on Facebook, you will like 1 or 2 hours, it's just easily fly past. Even Pinterest or maybe Instagram is the same thing. And then other than that, it's also gaming, because when you're playing games, you're already focused onto the game. So it's like all of your attention is only to that screen, so you don't have the time to like watch the show, or unless if you're able to multitask, you can only listen. But sometimes the movies are so attracting that you have to like divert your attention, which is quite hard to do for me. Okay. So now we know about the moats, the future plans, and also how they generate revenue. Here comes the most interesting part, is that how are their financials? Okay, first off, earlier on we see that their total revenues are increasing year on year. So this is a good sign. And then another thing is that their net income. So the definition of net income is operating income minus the interest and taxes. So what is an operating income? Operating income is actually the total revenue minus off the cost of goods sold, which is the direct cost to produce all these contents, and also some other operating expenses. So that is the operating income. So we can see that year on year, the net income is also increasing. So this is also another good sign. And also we will look in earnings per share. So what is earnings per share? According to value investing methodology, earnings per share means that for every share that you purchase, how many income or how many earnings can the company generate? For example, if the EPS is equals to 10, that means when I buy 1 share or an investor purchase a share, they will be able to get $10 of earnings from the investment. So when we see that the net income is increasing, earlier on from that slide is increasing, then the EPS is increasing. So this one is also a good sign. But then when we look at the operating cash flow, it's a bit worrying because we see that from 2015 until 2019, it's actually below zero, which is in the red. Why did this happen? It's because in 2013 onwards, they are starting to produce their own original productions. And we know that in order to produce original production, we need to first invest some money to produce the content before we can start earning. But then in 2019 and 2020, there was suddenly a sharp spike, followed by another sharp turn in 2021. So actually, what happened? So now we have to go into the numbers. So from here, we will see from 2012 onwards until 2021, we will look into two main aspects that will influence the operating cash flow. First is the net income, which is the cash flowing in, and then the other one is the cash flowing out.
So net income is the profit.
Net income is also known as the profit. So these are the two main components that is affecting the operating cash flow. So for the net income, starting from 2012 until 2021, is actually on an increasing trend. So you can see black color, that means it's increasing. However, in for the cash outflow, we see that it's in red. So that means they are actually spending money to create the contents or maybe to acquire the contents. And interestingly, starting from 2015 until 2019, it's already in the red, which was shown in the chart earlier. Because they are producing their own original content, so they need to put up some cash to produce all those original contents. Okay, then here shows that in 2020, there was suddenly a sharp spike. Do you remember? Because of that, it's because you can see that the net income in 2020 was actually increasing compared to 2019, but the cash outflow is actually decreasing in 2020. So which results that the cash flow from operation is in black color. So that means they are actually earning back some cash flow from there. But in 2021, there was a sharp drop back. It's because when we compare the cash coming in and then the cash flowing out, the cash coming in is still increasing. However, the cash flowing out is even more than what is increasing, which brings the cash flow from the operation to become lesser. So we wanted to know, like, cash flow from others, where is the cash flowing out from? So we can see from the cash flow statement is actually addition to contents. This is the major, huge chunk of it that they are spending money on. Okay, so here they actually have a document that explains that the cash cost for original content is more front-end loaded. Is because in order to produce this original contents, they need to first pay the actors, the producers, the place where they wanted to shoot, and even the tools they wanted to shoot. Okay. So now we will also look into their free cash flow. So the definition for free cash flow is operating cash flow minus capital expenditure. So the explanation for capital expenditure is that the cost used to purchase the assets that will last more than 12 months. Okay. So we can see that the free cash flow is also following the same trend as the operating cash flow, which is dropping from 2014 until 2019, a suddenly sharp spike before it comes down. But because in 2021, it's less than zero, that means it's already in the red. This one I will give it a cross according to the value investing methodology. Okay, so now we wanted to know how is their leverage, how much debt are they taking on? So we will see that based on value investing methodology, the definition debt over equity ratio is less than 0.5. So this means that for every $100 of the equity, the company can only take no more than $50 of the debt. Yeah, but when we see here, the current debt to equity ratio for Netflix is actually around 1. So it's actually above 0.5. So this one, I will give it a cross based on the value investing methodology. So after we look at the financial statements, we wanted to know, like, okay, initially Netflix looks very cool, looks very interesting, and also the EPS are increasing year on year, but then suddenly the cash flow looks like a bit worrying. So is there any risk does the company has? So the first one is that the original content will need a high investment because they need to pay a lot of cash upfront for the productions. So they need to find ways to generate more cash. And then the second thing is that if the production progress get affected, like for example, COVID-19, so no one can like go to a place to shoot because unlikely when actors are shooting, they might tend to be slightly closer contact and they cannot wear masks because no one wants to see actors with masks on, right? So they cannot continue with the shooting. And then because the shows are being disrupted, there will be lesser show available for streaming. So when the audience finds that there's not much show for viewing, then they might explore other entertainment channels and they don't see a need to subscribe to Netflix. And also renewing licensing rights. Other than producing their own original content, they also purchase some other licensing rights from other production studios. So if let's say the licensed shows leave the Netflix, they will have lesser show to show. So here is what they explain. Some titles will definitely leave Netflix because of licensing agreements. So there will be two outcomes. The first one is that if the licensing agreement is being renewed, it will still remain in Netflix for you to watch. But if it cannot be renewed, then they will let you know that the show is leaving. Yeah. And then the last one is that the members share password. So it's as if like I got one Netflix account and then I share my password with my friends, so others don't have to subscribe. And then this will definitely affect the numbers of membership sign up. So in US, about 1/3 of them, they are actually sharing passwords. So this one is actually quite scary because you imagine this 1/3, if all of them sign up for the subscription, they will need to pay for the subscription, right? But right now, someone is willing to share their password with them. They don't have to sign up and they don't have to pay. So it will indirectly affect how much that the streaming revenue that Netflix can generate. So to conclude, first off, is that Netflix is one of the largest streaming companies that we can see from the competitor chart. And then it has the highest number of subscription members right now. It's available in 190 countries. And the revenue and EPS is increasing year by year. But on the negative side is that currently the free cash flow is a bit low and also in the red. And they need to have a high investment to produce their original contents. And they will need to keep on creating much more interesting contents to keep the subscribers, to retain the existing members, and also to add on more new members. So with that, this is my sharing so far, and I will hand back to Cayden.
Okay, Cayden is back. Now, just to let you know that the almost every slide that I presented and what Hillary is presented is actually done by Hillary, so I have to give her credit for it. We have quite a bit of discussion on this company. In fact, there are a lot of technical things on the accounting side, for example, amortization of content. There are a lot of technical things, but to make things, I think, to make life a bit easier, we remove the accounting and technical part. Yeah, which is why if you are watching this live streaming right now, right, things are a bit easy, and because we made it that way. Okay, so I'm just going to focus on this slide again, just to make sure that everybody can see this slide, right? Now, this is a slide where Hillary has left off, and then she talked about the pros and cons if you want to invest in Netflix. Now, all these things looks very nice. So initially, when I look at the numbers, the revenue, the profit and loss side, it looks really nice. But my concern is really the cash flow. Yeah, the cash flow, right? Once we get to know more, we realize that in order for them to generate content, right? Yeah, they have to put up a huge amount of cash up front. Yeah, put cash up front. And after they put the cash up front, whether they can get the cash back or not, that's a secondary thing, right? So in other words, they have to cough out cash first. Yeah, so initially we thought that they really make a lot of money, which is true from the profit and loss side. But from the cash flow statement wise, we saw, Hillary explained the cash flow from statement, right? It went to negative. So it goes up, then after that it comes down again. So we realized that there are two variables that really affect the life and death of Netflix. Yeah. So I think revenue, profit-wise, I don't see there's an issue, but the outflow of cash to acquire content, right, is really an issue. Yeah, and any small little movement in that cogwheel, right, you will affect the overall company's cash flow. So this is really a tricky part. And if there is no COVID, it's still okay, but we have no idea when this COVID will last. So this is one really biggest concern, right, that we have regarding the cash flow. Now, so of course, the ultimate thing, right, for any investors, they want to know is can buy or not. You know, after we talk so much, me and Hillary talk so much, I mean, 205 of you, Cayden, can buy or not? You know, that kind of thing, huh? Now, so what I'm going to do next, now, in order for us to know whether can we invest into a business, there are two key questions. The first question, right, that all of us have to answer is if Netflix is Netflix, right, a good company? Yeah. So if you look at all the financials, the thing that we say, is it a good company? Yeah. So this is the first question. It's either a yes or a no lah, or sometimes it can be not sure. So if it's not sure, then you better give it a miss. If the question is, if the answer is yes to the question I've said, right, then of course the next part is right now when the share price has dropped by about 48%, right, is it the right time to make an entry? Now, before I tell you the answer, right, you know, like any typical streaming movie, let me keep you in suspense, right? Now, so this is like an ad break. Oh my goodness, Cayden, you're supposed to tell me the intrinsic value. Suddenly there's a commercial ad. Now, so in the next 1 minute, there will be a commercial ad. So what is this commercial ad, right? Now, if Netflix is not something that you wanted to do and you want to invest in other companies, that's much easier. Now, just to let you know that based on what I've shared and based on what Hillary has shared, these are just typical examples of work investors do. Yeah, so it can be fun in a way because the more we read, the more we find things interesting. So in other words, in the upcoming 12th of April, right, including 28th April, we are actually organizing a class so that you can learn what me and Hillary do, yeah, from an investor's perspective. Yeah, understanding more about business, and it's quite interesting, huh? And the class, right, for 3 hours is only $8. Yeah, and just to let you know that we do not keep the $8 because every single cent, right, of these $8 are all donated to National Cancer Center of Singapore. And the reason why of all charity organizations we pick NCCS, right, is because I'm their campaign ambassador out of, I think, 8 or 9, right, and ambassadors to help them raise 150 million by end of next year. Yeah, so this is like our job. Yeah, so $8 is a very small bit as compared to 150 million, which is a lot, right? So, but, you know, we do bit by bit, huh? Now, if you attend this, any of this master class, right, if you are a graduate, you don't have to attend, but you can bring your friends, you can bring your friends, right? If you bring your friends, I mean, for you, you don't have to pay, but you help to pay for your friend. Okay, so once you or your friend or whoever registered for master class, they appear, right? Let me share with you what are the 2 things that you receive at the reception. At the reception, right, we will pass you 2 copies of a guidebook. Yeah, guiding notes, guide notes, right? Notes, So 1 set of notes, 2 sets of notes, and this is to teach you how to invest in exchange-traded funds. Now, STI has generated about 7.9% since the beginning of time, and the S&P 500 has generated about 10.9% since the beginning of time. So these are practical, step-by-step a guide, right, on how you can get started investing with just a mere $100 per month. So in other words, if you don't want to spend the money paying the Netflix subscription, right, the alternative way is to make money, right, by investing. So reception, you receive two guide. And then not only that, at the end of the class, this is even better than watching Netflix. At the end of the class, we will give you a hard copy, not ebook, a hard copy of a national bestseller, which is called Investla, and it's worth $33. And then not only that, right, we want you to drink coffee while reading. So we're going to give you a Starbucks, a prepaid gift card. Okay, so this 33 plus 10, already 43. 43 already higher than 8, right? But not only that, for this month only, right, we are going to pass you our latest book called Value Investing Simplified, where the foreword is written by Laura Templeton. And this is selling, right, retailing at online at $20. So in other words, in total, by donating $8, right, you'll receive $63 tangible worth of 2 books and 1 Starbucks gift card. And inside there's a stock value of $10. And here's an ROI of 688%. Yeah, so I'll need our team member to post the 2 link, right? Yeah. So while the 2 link is being posted, let me share with you what is the, how should I say, right, the return that you're going to get, which is much more than watching a movie. Now, so on the masterclass, which is on the 12th of April, you just need to pick one, right? Yeah. So during the 3 hours, you learn 3 very important things. Yeah. Number 1, you will learn how to generate 3 sources of passive income, right? Even if you know absolutely nothing about investing. So in other words, once you have 3 sources of passive income, you can actually use this passive income to pay for a Netflix subscription, right? Which means that the Netflix subscription is free, or you can use the passive income to buy a pair of shoes, then the shoes are free. Or you can use that passive income, let's say, to pay for a kid's tuition fee. Yeah, so in other words, in this world, there are free lunches, provided you know how to generate the multiple streams of income. Then, of course, to generate income, you need to put up some investment, right? And be rest assured that you will learn how to invest with minimal capital, which is about $100 per month basis. Yeah. Now, and of course, the last one, right? This is one of our graduates' favorite, is to practically learn how to print cash, right? Using this method called cash flow option strategy that's used by one of the richest men on earth, and his name is called Warren Buffett. So in other words, you will learn exactly how he print cash. So in other words, on this 12th of April, these are the 3 things that we're going to learn. Let's do a quick recap, right? These are the 2 dates. The links are already there. Okay, so at the reception, you'll receive these 2 hard copy, right, guide. And then at the end of the session, you'll receive 2 books, Value Investing Simplified, Investla, and then you will also receive a $10 Starbucks gift card. Hey, by the way, this gift card is not free. We actually have to pay Starbucks $10, right, for them to give us the card. It's like EZ-Link card, no? Yeah, where inside there's a stock value and it's $10. I think $10, I think you can maybe buy 2 cups of coffee, or a cup of coffee with a small slice of cake. Okay, so then you can read the book as well. So remember, $8 to charity. What we're going to give you back is $3. So the ROI is 688%. Now, so that next time you know who is VIA, Value Investing Academy, right? While you're drinking a cup of coffee, you know who we are. But that's not the end of this session, right? That's not the end of the session. It is because we're going to take maybe 8 minutes, 8 minutes registration break, right? So during this 8 minutes, if you are not our graduate, but you are watching this, the 200 of you, right? You just need to click on the 2 links over there. In case you cannot see the 2 links, right? You just refresh, right? Yeah, refresh the YouTube one more time. The 2 links will pop out, Just click on the 2 links, register during this registration break. And if you are a grad, you can go to the toilet whatsoever, right? But that's not the end. Yeah, that's not the end, right? Remember, in the very beginning, we talked about 2 crashes. One is the crash of Netflix share price by 48%. And then we're talking about the future recession. So after this registration break, when we come back, now, number 1, I'm going to talk about the entry price or the intrinsic value of Netflix. Then from there, we can have a short discussion. We have some poll, right? Whether would you buy Netflix or not. Okay, so that's after the break. Then after we have done the poll with Netflix, we're done with Netflix already, right? Yeah. Then we're going to proceed to the next part, which is very exciting. And I'm going to share with you 3 indicators that point to only one direction, right? That in the next 6 to maybe 18 months, there's a high probability there might be a recession. And if there is a recession, right, the stock market will collapse. And if the stock market collapses, it will present vast opportunity, like ocean, right? Vast opportunities for value investors to really cherry pick, right? What are the companies to buy, and that may include Netflix, which is why we're going to do one case study first, okay? Because the share price may fall further, okay? So let's go for 8 minutes break right now. We'll let our teammate set this 8 minutes, and during this 8 minutes, just to let you know that quite a 2 of our team members are here in case you have any question about the registration, right? Yeah, please feel free to post any question. If not, I shall see you 8 minutes later. Hi, this is Cayden from VIA Value Investing Academy. Welcome back. Just now, right, during the so-called short registration break, I noticed a interesting phenomenon. I was looking at the number of people watching the YouTube, right? So initially it was about maybe 207, 208. Then we say we go for a registration break. Then I saw that 207, it goes to like 170. Quite interesting, huh? Yeah. So 70, they go for about maybe 30 plus, they go for a break. Okay, now the number is back. It's quite interesting, huh? Quite interesting, Okay, let's come to the part. Now let's assume that whatever we have shared and you have concluded that Netflix is a good company. Let's say. So now the key thing is it a good buy? It's a good company, but is it a good buy? But good buy, there's a 2-part, right? It's good, and whether can you buy it now? Buy it now, So in other words, from a value investing perspective, right, we have to know the valuation. In other words, how much is one stock of Netflix worth? And you want to buy below how much it's worth. Then it's called undervalue. Now, there are 3 perspectives that I want to share. One is from Guru Focus. Guru Focus is some subscription site, right? And this black line, right? This black line is their is their so-called calculation of intrinsic value. But remember, they're just using some machine, right, to calculate. They don't really use human. And right now the share price is here, which means the share price is below their intrinsic value. And their intrinsic value is 590. You wait till I finish this first, then you do a screenshot, right? Which means that from group focus perspective, it's undervalued. But bear in mind, here it says possible value trap, think twice. So what do you mean by value trap, right? Value trap, that means the company appears to be cheap, then you press buy, then you realize how come the share price never move. Yeah, so it trap you there at the share price. So it's called a value trap. Value trap. So this is from guru focus perspective, undervalued, but it could be a value trap. So that's one. Now, second one is from Morningstar. Morningstar is in the investment world, is quite a reputable site where they provide information about stock advisory and so on. So in this case, right, their intrinsic value is 305. Yeah, so the share price is 373. So you see it contradict each other, right? So right now, from Morningstar perspective, it's overvalued at 22%. Yeah, you see, the problem with such site is, number one, you do not know their algorithm because they don't tell you how they derive an intrinsic value. Yeah, and then if you press buy, if you believe in group focus, you press buy, right? And then something goes wrong, you cannot blame them, you see. Yeah, because you don't know their algorithm, so how you got nobody to talk to, right? Yeah, there isn't a cadence behind guru focus, Morningstar to chit chat, you know. So I leave it to you, right? Guru focus undervalued, Morningstar is overvalued. So there's two contradicting opinion, right? And you have no idea what's happening at the back. But let me just share with you my thought. So what I did was I did my own intrinsic value calculation. Now, I'm a very, I'm not saying very, I'm a more conservative person. Yeah. So my role at my age, right, is to protect my capital, right? Yeah. So my variables that I put inside our VAA calculator, which will be, so-called covered in a masterclass, derive at this intrinsic value of US 257. So as of this afternoon, the share price is 391. So from my perspective, the group, not group focus, what am I saying? The Netflix is overvalued. But this is my assumption. My assumption is I project, this is actually not conservative, this is really quite optimistic. Right? So even if I project 10 years of compounded annual growth rate at 20%, right? Yeah, okay, which is actually very hard for Netflix to achieve. Yeah, and then followed by 10 years or 2% of terminal growth, and then 30% of margin safety, right? I derive this. So in other words, even though I'm conservative, right, but I purposely put in an optimistic number, and this number is supposed to be large, but unfortunately, the share price appears to be very far. 257, I think it's about here. If I'm going to draw one line, right, 257, I think it's about here. Yeah, so the share price is here, so you just have to, sort of wait if you accept what I put over here. Okay, but let's play a game. Let's play a game, right? I just want to hear from 290. It's serious. The toilet one really came back already. Just that was 100 plus. Okay, so I want you to look at this diagram, right? And I want you to just type A, B, or C. Now, and this is, if you watch the presentation about Netflix, this is just a game, just for fun, right? Can you please type? Now, you can type either A. That means to you, buying Netflix, right, is a low risk, high return investment. Okay, boleh, very good. Now, or you find that it's a high risk, high return investment. Or do you find it's a high risk and low return investment? Okay, so I'm going to give you like maybe 10 seconds to just type this inside the chat box, right? Yeah, this is just for fun, just for fun, right? Whether it's A, B, or C, and you can scroll through the poll. Yeah, A, B, or C. So you just type A, B, or C. Then after that, we move to the recession part. In case you find that, alamak, this is too dangerous. Yeah, then I'll tell you some other things that is more interesting than Netflix. Okay, so I just wait for a few seconds because sometimes when you type A, B, and C, it takes a while. Yeah, so Angeline says it's C, which is okay, right? Remember, nobody has a monopoly over opinion. This is not a fact, right? Yeah, so far is B and C, right? Okay, B and C, so B and C. Anybody? B and C, continue, Frankie, Helen. Okay, while some of you are typing this, the poll for fun, right? A, B, or C, so maybe I'll just continue teaching something. Now, this so-called, this three category of basket is a very simple idea that is suggested by Charlie Munger. And Charlie Munger is the current vice president of Berkshire Hathaway. And Berkshire Hathaway a huge company owned by Warren Buffett. And Charlie Munger once said, when you did all your research, you reach one point of time where you had to decide whether to buy or don't buy. And to decide whether to buy or don't buy, right, you need to put your choice into 3 different baskets. But you can only put a choice into one of this. Basket A, low risk, high return. Basket B, high risk, high return. Now, if you put your choice into basket A, right, this is a buy. This is a buy, if that's what you choose. Now, if you put into basket B, right, this from Charlie Munger perspective is very difficult. Very difficult as in once you put inside here, at night you cannot sleep. Why? It's too difficult. Yeah. So in other words, you're putting your hard money into something that you cannot sleep. But of course, if you buy one Netflix stock just for fun, $300, and you don't mind losing it, you treat it like a lottery ticket or some learning experience, maybe still not so harmful. But if you put 30K, I think that's a separate story. Yeah. So let me scroll through the poll, right? It's predominantly B and C. So remember, right? If your choice is B and then you buy Netflix stock, remember, it's a high risk, high return. At night you sleep or cannot sleep, I leave it to you, right? Now, then for those people that choose C, choose C is don't buy lah. Don't buy lah. Okay, don't buy Netflix stock. Just watch Netflix can already. Okay, okay, got it. So this is how you choose. So of course, in the entire how should I say, right? Investment process research, right? This will be covered in the masterclass. And just now, our team member has posted the link. Maybe I just ask the team member to just post the link one more time, in case while I speak, right? They didn't have a chance to register. Yeah, so remember, right? Understanding investment is really there's a structured way. You cannot anyhow tikam, right? Okay, so let me just move on. Now, I purposely put this picture. I was thinking, if Cayden wants to buy, and right now the price is a bit high, right? Then this picture is to show that I'm willing to wait. This is quite cute, Yeah, hey, I'm not. Yeah, but by the way, in Netflix, there is a movie, but I don't think it's Mr. Bean. It's called what? Johnny English. Correct? Yeah, Johnny English. Yeah, Johnny English. By the way, just to let you know that Johnny English is one of the most ridiculous movie that I ever watched. Yeah, so let me just sidetrack for 1 minute, tell you some silly story. It's before pandemic, I think it's about 2 years plus ago, right? I have a good friend, the real name, his name is called Paul. Yeah, so Paul was one guy that connected me to a Taiwan event organizer. Yeah, so when I fly over to Taipei, right, specifically, Paul liked to hang out with me, and because I'm alone, he's a guy alone, right? So each of us just go for a dinner and so on, Then got one day very funny. There's one day that Paul was so bored that he asked me, "Hey, Cayden, do you want to watch a movie?" Yeah, movie. Now I cannot remember the last time that I actually watched a movie with a man, but Paul said, "Well, I'm quite bored. Can you watch a movie?" And the interesting thing is we actually watch a movie together. Midnight movie. Can you imagine? Right, there are two guys. They are walking very close together, right, on the street of Taipei. And these two guys actually entered a movie theater together. Wow, interesting, And then the movie that we paid is Johnny English. Wow. Now I think back, I also cannot recall I did what I did, but I think it's from friendship, From friendship, right? Now after that movie, we have never watched a movie ever again together. Okay, but anyway, it's got nothing to do with Paul, right? Okay, this side joke. Let's come to this part. When they say cute picture, quite funny, Quite funny, Hey, by the way, this Johnny English, Mr. Bean, PhD, PhD. I think his PhD is engineering. Yeah, so don't play. You cannot judge a person by the face, right? By the face, You look at Albert Einstein's face, so you cannot judge a person by the face, right? Okay, Diraj is in Switzerland watching this live. This is the most interesting part. So we are done with the stock market crash of Netflix. So right now, let's talk about the world. Now, at the very beginning of the presentation, I talked about the Fed has made a recession inevitable, all this article and so on, right? Now, and we are done with the share price of Netflix. So let's talk about the global economy, right, and the global stock market. Yeah, is there a recession coming? Can you feel the storm? And then the sky suddenly become very cloudy and then become very dark. Now, just to let you know that in order, Wendy, yes, it's PhD, right? PhD engineering, Dr. Mr. Bean. Okay, so there are actually there are many indicators for us to know whether are there some whether a recession is coming. Now, so let me share with you three very important indicators. Now, usually if you watch any other videos or whatever, usually they talk about number 3, which is an inverted yield curve. Yeah, but there are actually many. So instead of just seeing one telltale sign, right, we want to make sure that 3 stars are aligned. And these 3 stars are aligned, it sort of give you some feeling, right, that a crash may be coming. Okay, so let's look at the first one called Shiller PE ratio. Now, if you are a graduate, you will have learned this formula, right? A very simple ratio called the PE ratio. PE ratio means P means price. Yeah, price for one share, right? And then E, that means earnings per share, price per share. And of course, based on the book written by Professor Benjamin Graham and David Dodd in security analysis, they want PE to be less than 16. Yeah. So this is the typical PE that all investors know. But remember, right, the PE ratio that we're not talking about is the PE ratio. No, there's another word in front called Shiller PE ratio. And why Shiller PE ratio and not PE ratio, right? Now, just to let you know that PE ratio, unfortunately, is not appropriate or accurate ratio to see the overall market. Because if you look at the formula, there's only 2 variables. First is price per share, and the other one is earnings per share. So what happened is there is this famous professor, he's still around. By the way, he's a Nobel Prize winning economist, and currently he's lecturing in Yale University, which is one of the top universities in the world. Yeah, so in other words, it's not BSing, saying about this. So what he did was he take this traditional P ratio, he did certain modification, right? And then he give it another name called Shiller PE ratio, named after him. Yeah. So this is some technical thing, but in short, you see, there's some technical thing how he derived the PE ratio, the Shiller PE ratio. But in short, right, to make things easy for you, for layman, in short, the higher, right, the PE ratio, the worse it becomes. It simply means that the overall stock market is high. So what we want is we do not want to see a high Shiller PE ratio. We want to see a low Shiller PE ratio. But what is high and what is low, right? It's so subjective. Now, let me share with you some interesting facts. This is not opinion, right? This is facts. So facts are undeniable. Now, if we travel back in time in 1929, there is this very huge stock market crash. Is even worse than a recession. That's why they didn't use the word the Great Recession. They used the word the Great Depression. It's so depressed that, can you see this sign? Why can't you give my dad a job? Yeah, so during the Great Depression, if people want a job, don't have. Right now in the Singapore context, there are many jobs, but people don't want. So very interesting. Instead of the Great Depression, I also don't know the Great something else. Okay, but anyway, this one aside, right? Now, so what happened is Professor Robert Shiller find that, before every crash, the Shiller PE, right, is always at the all-time high. So in other words, before the Great Depression, the Shiller PE ratio is 32.6. That's even much higher than now, 32. Okay, so in other words, every time when a Shiller PE ratio is sky high, strangely, right, months down the road, there will be a crash, recession or depression. So that's one. Now, let's gather more evidence. Facts is all about gathering evidence, and then we try to infer something, right? So let's see if this Shiller PE ratio can tell the dot-com bubble burst. Now, dot-com bubble burst on 4th October 2002, right? Now, if Shiller PE ratio works, which means that before the dot-com bubble burst, the Shiller PE ratio should be all-time high, right? Yeah, if it works. So let's look at the facts. Now, can you see here? 1999, the Shiller PE ratio is 44. Can you see? Then after that, the dot-com bubble burst. Okay, but so 2 data points, right? Let's gather more evidence. Now, remember the most famous or infamous 2008-2009 global financial crisis, right? Now, if Shiller PE ratio is really a good indicator, which means that before this global financial crisis, the Shiller PE ratio should be high, right? Somewhere high, right? So let's look at more detail. Now, can you see here? Yeah, there's 1 point high over here, right? There's also another point high over here. Yeah. So based on at least 3, actually this Professor Shiller, he actually went back many years, but I'm just using 3 data points to let you know, right? So right now, where are we today in terms of Shiller PE ratio? Are we at all-time high or all-time low? So ready, Ready. Now, this is the Great Depression, right? This is the dot-com, right? This is the financial crisis, right? Where are we? We are here. Can you see? As of 5th of April, Shiller PE ratio is 37.4, which is higher than, is worse than the global financial crisis, and it's higher than the Great Depression. So now the question is, with the war happening, right? Russia attacking Ukraine, and it seems like President Zelensky didn't want to take a neutral position, and then US is providing weapons. Wow, it's quite hard to foresee. And then right now, I think the most recent one is President Zelensky was criticizing UN. Oh, you're supposed to come in. But the question is, does UN, right, or NATO, do they want to send their soldiers to fight for them? Because if they do, actually, it also means that they want to have a war with Russia. The last thing we need is to have a, a nuclear warfare, right? Since the two bombs that dropped on Hiroshima and Nagasaki. Okay, so can you see all these things that's happening around the world? While we thought that life is better, pandemic, we can take up masks. Yeah, this is happening, So this is one indicator, and if this indicator is right, is true, then in months to come, there may be a great recession or a great depression. So that's one. But from a scientific perspective, let's look at more data. Now, so Shiller PE ratio is 44.5%, higher than the 20-year average. Yeah. And then remember, right, a recent 20-year high is 38.8. Yeah, so we are actually at the 20-year high. Okay, it's not a good thing. Not a good thing for other people, but for value investors, it's a good thing. Okay, ready? So we are done with this, right? So let's look at another indicator so that we got more facts. The other indicator is called Buffett Indicator, right? Named after Warren Buffett. Now, so there was once Warren Buffett said, oh, this indicator, actually he didn't say, oh, this indicator should name after me. He just said there is this indicator, and then this indicator is the best single measure of where valuations stand at any given point. Now, remember, Buffett didn't say that if this indicator is higher, there will be a recession. No, he didn't say this. He just said that this number, this metric, right, when it's high, that means the overall stock market is overvalued. Now, remember, he didn't continue that, oh, after this, there's a recession. Okay, so take it this way, right? And he also didn't name after himself because somebody else said, hey, Warren Buffett said this. Let's give this ratio a name, and then they call it Buffett Indicator. So what is really Buffett Indicator, right? Now, it's a ratio, and then the numerator, right, yeah, is this total US stock market valuation. Don't worry about technical part. The second thing, right, is GDP. So now this is the numerator on top. The denominator is GDP. Now, if you have like watched some parliament, ministers, they like to use this word GDP. And if you are non-economic person, investment person, I mean GDP, right? I mean, what's GDP? If you want to impress your friend, tomorrow you go back to work, you say GDP. GDP. They also don't know what the hell you're talking about. But let's come here. Sorry, I shouldn't use such a word. Now, so what is GDP, right? Now, GDP in simple terms stands for gross domestic product. Now, in short, is the total, is a number, right? Number is a total goods or service, right, produced by a country in a given specific amount of time. Now, so what does it mean? Now, usually in, like, for example, during a pandemic in 2020 and 2021, right, where businesses close. You see, when business close, they cannot provide a service, right? They cannot sell a good. Yeah, which means that during bad time, during recession, the GDP is supposed to be on the low side, right? Yeah, because business closed, they got no service or product to sell, so GDP is on the low side. Yeah. Then if during good days, GDP number tend to be on the high side. Yeah, which means that in simple term, right, GDP measures the health of a country, the economic health. Yeah, economic health. A country with high GDP, that means good economy. Yeah, a country with low GDP is poor economy, which means that Singapore always talk about GDP because, oh, I want a high GDP. It's a sign of booming. Everybody is booming. So remember, right, this GDP is at the denominator. Then the question is, what is this US stock market valuation? Now, here I think I will skip the part about where to get the data because it's a bit technical. But this is I got some sources, right, where currently the entire US stock market valuation, right, is at this 48.9 trillion, 48.9 to make it simple, right? And then GDP is about 24.2. Yeah. So if I take this divided by this, can you see this divided by this, right? Yeah, and then multiply by 100%, you have 202%. But what does this 202% mean, right? So if I give you some guideline, which means that 202% belongs here. Yeah, if it's above 143, right, that means the entire US stock market is overvalued. Yeah. So as of this point, how do we connect the dot? Now, the first dot is Shiller PE ratio is all-time high, 20 all-time high. And based on the past, right, whenever the Shiller PE ratio is all-time high, it is followed by a crash. Okay, so this is one data point. The second data point is in addition to this Shiller PE ratio, right, the overall stock market is really high. Now, which is also true because we are still not out of the woods yet for the pandemic, but the entire US stock market is really on the high side, Yeah, so I find it quite hard to register. Yeah, so there are really two data points that point that the stock market is high, there may be impending crash. So this is Buffett Indicator. So this is another graph. And this line, right, represents the historical trend. Do you notice that at this point, when the Buffett Indicator is very high, the dot-com bubble burst, right? Can you see? Year 2000. And right now we are here, and it is even worse or higher than the dot-com. Yeah. And if you are old enough to record the dot-com, right? Now, why the dot-com bubble burst is because there are some companies which didn't make money. But they paint themselves, right, that, my company is a dot-com, how big deal. So venture capitalists start to pump in money into their dreams, but they do not have any sign that they are making money. And if you take that symptom, right, and you map it to today, now have you come across companies that don't make money, but people pour money inside? Yeah, one good example, Grab, right? Grab, Why it's called Grab is because Grab want to grab your money. That's why it's called Grab. No, sorry, this is just a lame joke. Anthony Tan will be quite unhappy with this. But so Grab, the IPO, they grab your money, right? Now Grab until today is not making money. Yeah, but people like show hand. So that's one. And such companies are called unicorn. Right now it's called unicorn, right? Yeah, in the early days it's called .com. Yeah, so what they did is they take the .com thing, put down, and then they put another label called unicorn. Yeah, so why they call unicorn? Unicorn is a horse with a horn, right? Because unicorn is a mythical animal and it doesn't exist in real life. So in other words, when you are buying a unicorn, you're buying a mythical creature which may not exist at all. And Grab is not the only one. So do you realize that right now we have companies that listed via SPAC? Yeah, Grab is one example. And recently there's another one, I think it's called Property Guru. Yeah, Property Guru is another one, another unicorn. Yeah, then what's another one? Is it Lazada? No. Shopee, right? Shopee, right? Yeah, Shopee. Yeah, Shopee is under this company called SEA, right? SEA Limited, right? And then just a day ago, I happened to see one YouTube ad. Now, YouTube ads are simply ads that you don't want to see, right? But they force it on you. For the first 5 seconds, you must see. Yeah, so you watch a YouTube, then suddenly Cayden appear. Force you to watch for 5 seconds before. So there's one YouTube ad that I think a training provider say SEA Limited is super stock because the revenue is growing. But remember, right, revenue is vanity, profit is sanity. So the company produce nothing. In fact, it's on the red. So it's quite dangerous to put a bet that the company is not profitable yet. If you buy one stock, it's okay, but you show hand, I think it's a bit dangerous. So all these are telltale signs that right now, the label of .com has been replaced by unicorn. And this one points to one direction. Yeah, stock market is overpriced. People are putting, there's still more, right? Right now, people are throwing money into what? Crypto. And of course, crypto is old school already. If you say crypto, you're lame. Right now, the in thing is NFTs. Yeah, NFTs. So what is NFT, right? NFT is called non-fungible token. Now, if you do not know what is it, you must watch our previous live where Hillary talked about NFTs. Yeah, so right now, the talking point is tomorrow if you go to work at the pantry, right? If you make a cup of coffee, you must talk to your friend. Hey, yesterday I just bought one NFT. Then your friend asks you what's NFT. Oh, NFT is, well, then he got problem trying to explain to you what's NFT. Yeah, so if he has problem explaining to you what's NFT, that is an NFT. Okay, in short, it's like a JPEG file that exists in the decentralized world, right? And people are willing to pay $1 million for an ape-looking JPEG file. So that's called NFT. But putting that aside, all this are pointing to one direction is people are just throwing off money, right, into something that doesn't make sense. NFTs, maybe that makes cryptos don't make sense. Companies, unicorns, last time called .com don't make sense. So these two things already, but that's not the end, Yeah, that's not the end. So let's look at one more thing. And this thing is recently a lot of influencers like to talk about this thing called inverted yield curve. Now, if you look at these three terms, we need to split these three words right into two words first. So in other words, I need to explain what is a yield curve first. This is the first thing. Then I'll explain what is an inverted yield curve. Okay, this is a bit technical, right? But I'm going to make it as simple as I can. As simple as I can. Now, so there is this article that said that this market measure, which is the inverted yield curve, has a perfect track record for predicting US recession. Oh, ooh. Okay, so let's talk about what is a yield curve before we talk about what is an inverted yield curve. Now if you look at this sentence, it's a curve on the graph. So in short, on the y-axis, right? On y-axis over here, it is the yield of fixed interest securities. Now, yield is simply return. Return. Okay, let me give you an example. Let's say you put your money into a bank, right, into a fixed deposit. Okay, and let's say DBS Bank say, oh, if you leave your money with me, every year I give you 2%. So this 2% is the yield or the return if you put money in a fixed deposit. But in this case here, we're not talking about fixed deposit. We're talking about a fixed interest security. Yeah, it's like a bond, right? Or some kind of stock where you put the money there, right? They guarantee you a certain return. Okay, a certain return, right? So this is the y-axis. Now, then the x-axis is the time. Yeah, they have to run to maturity. Oh, Preston say great resignation. Oh, yeah. Hey, Preston, you're quite funny. So 1929 is the Great Depression. Oh, yeah, actually, you're right. It's called the Great Resignation. That's why in Singapore, there are many jobs. Okay, sorry. You shouldn't say something. Now I get a bit distracted. It's so funny, I find it very hard to continue to explain this yield curve. Okay, but, okay, so let me explain. You see, next time don't say this kind of funny thing. Okay, don't distract me. Okay, so the yield, right, is on the y-axis. Now, that x-axis, right, you see, don't say this kind of thing. Now, the x-axis is called the length of time where they where they have a run to maturity. Okay, in short, what does it mean? Now, if let's say you put your money right into, let's say, deposit, fixed deposit, am I right to say that the longer you put inside the bank, the fixed deposit, right, the longer the bank is supposed to reward you? Yeah, so in any typical fixed interest instrument, it always works this way. The longer you put inside, you leave the money with them, right, the higher the yield. It's always like this. Okay, so this is any typical yield, right, of a fixed interest security, such as a bond. Okay, so the curve is always like that. Yeah, so the first 5 years, they tempt you first. You live inside 5 years, my return is, let's say, 3%. Yeah, then the longer you put in, let's say 30 years, am I right to say that it's higher? But the curve always curve upwards. Like that. So remember this curve, right? This is a typical yield curve, which means that, in short, the longer you put your money right inside a fixed interest security, the higher the yield. Okay, so this is a typical normal yield curve, not the inverted one. Now, so this is what I say, right? For example, you put in a short-term bond, you put short-term then low, you put long-term then higher. So which means that between this, okay, let's say this is a 6%. Yeah, so let's say this is 2%. So you see that there is a spread, right? There is a gap in between. Yeah, so this is a typical normal yield curve. But there are some yield curve that is not normal, not typical. One is called a flattened yield curve. But this is outside our syllabus. The one that we are talking about is an inverted yield curve. Can you see? Just now the line goes something like this, right? Now it goes the other way, inverted yield curve. So what does this mean, right? What does it mean? So I make a reference. Remember, this is a normal, typical yield curve. This is an inverted yield curve, right? So what does it mean? I'm going to go really slow, right? Because this is a bit technical, right? Okay, so just like I said, there's a positive spread, right? Because here is 6%, this is 2%, 6 minus 2 is plus 4%. Just take note, a normal typical yield curve will always have a positive spread, okay? Now, let's look at inverted one. So what does it mean? Now, let's first, let me just explain, right, why the curve is inverted. Okay, this is very important. Now, in any environment where the stock market or the economy it's very jittery, right? Where people worry, if I buy stocks, if the stock market crash, how? You know, that kind of thing. If I invest in this, if the stock market crash, how? So they are worried that if I put my money into some securities that they fear they may go to zero. So usually these people will start selling the stocks because it's dangerous. They want to shun away, right? So if they are dangerous, they shun away. Where would they move their money, right? The money will be shifted to bonds. To bonds, which is why sometimes when you read news, people, during recession or whatever, right, they dump things that they perceive to be dangerous, and then they buy things like gold, gold, or they buy things like bonds. So I want you to imagine that maybe bond costs $10, let's say, each unit. Then suddenly there's a rush, the huge rush of people to buy the bonds, right? Yeah, so if you're the one selling bonds, wow, there's so many people rush to buy bonds, right? The price will get higher and higher, right? Okay, so when there's a high demand for bonds, especially for very long one, because they want to protect themselves for a very long time, right? The price of bonds will rise. So if you overpay for bonds, right, am I right to say that your return will drop? Your yield will fall, right? Okay, so so what does it mean? It simply means that sometimes the demand is so high that people start to overpay, right? And then the return will fall low enough, which is even worse than the return for short-term government bonds. So what does this mean? Now, let me give you an illustration, right? You see, if people rush to buy bonds, buy bonds, especially long-term one, right? And because they overpay, then the yield will become low, right? Yeah. Then the short-term bond is here. So right now, the original short-term bond is scarcely, maybe it's 2% over here, right? And then because the yield has become, let's say, 0.5%. Am I right to say that if I take this 0.5 minus this 2, it becomes a negative spread? Negative, right? Yeah, negative spread. So now the question is why? Got the writing over there, but it's okay, right? So the first thing is, like I say, because they are nervous about possible recession and so on, right? And just now the 2 indicator has already indicated that, right? Stock market declines, so they rush to buy longer term bonds. And then because of that, the yield become low. Now, that's why the curve looks this way. And not this way. So in other words, an inverted yield curve is a quantitative measure, right, of the overall market emotions. Now, which means that if the yield curve is inverted, it implies that people are rushing to buy long-term bonds, even though they know that the yield, right, or the interest will be lower than the short-term bond. Yeah, so this is highly irrational. Yeah, so in other words, it is to describe the feeling. In short, if you put these 3 dots together, Shiller PE ratio all-time high, and it's also followed by a recession. Then the second one is Buffett Indicator also high, and then this one, the curve inverted. Yeah, all these 3 quantitative measures is pointing to one direction, that we may be heading for a recession. But let's look at the past and see whether does inverted yield curve is inverted yield curve a good predictor, right, of a recession. So ready, Now, let me explain to you what this graph means, right? Yeah. Now, this percentage over here, it is derived, right, from the yield. Let me just show you this, right? It's derived from the yield from longer short-term bonds minus the yield, right, the yield from the longer-term bonds minus the yield from a short-term bonds. So in other words, remember, longer-term bonds supposed to have higher yield, right? Yeah. So in other words, if this line is on top, it's normal. The yield curve is a normal yield curve. But on zone like this, if it goes into the negative zone, right? Yeah. No, the moment it goes below the red line, that means this spread, right, has become negative. Yeah. Below red line, this curve has inverted. So let's see in the past, is it a good predictor of recession? Now let's look at the first arrow over here. Can you see? Now this line has grown from positive to negative. Yeah, which means that the yield curve has been inverted. First sign, right? And then after that, this gray zone, can you see this gray zone over here? It's a recession, US recession. Then after that, the second one, right? Yeah, the spread has gone from positive to negative. Then do you see here? Recession, the gray zone. Okay, let's do it one more time. Third one, right? Positive to negative. Then after that, gray zone here, can you see? US recession. Then one more. Positive to negative. Then the dot-com bubble burst, right? Can you see? Then one more. Here, right? Can you see? Positive, spread to negative spread. Then after that, the global financial crisis. Then do you see here this part? Now this part I didn't indicate because it just, you know, it's like, how should I say, right? Like want to invert, don't want to invert, no. They like I might pop. Then can you see the stock market crash over here? Yeah, so this one is like yeah, invert or not. Okay, so far based on the facts, right? As long as this spread goes from positive to negative, the curve is inverted, and after that the recession will take place. So far is the really accurate indicator. But the question is now, right? Has the curve inverted? Where are we today? Okay, ready? Treasury yields invert as traders weigh US recession. Now, here there's a whole chunk of text, but let me explain to you, right, in simple terms. Let me summarize. Now, this is a short-term, like a bond, fixed interest instrument. Now, the interest is 2.42. Theoretically, the long term should be higher than this, right? So, do you realize that the short-term one right now is bigger than this? By a bit only. Yeah, so 424, and then here is 412. So, the curve has been inverted. And then they look at another fixed interest bond, 2.56. It's supposed to be smaller than the 2.43, but it's bigger. So in short, as long as the yield, right, for short-term instrument is higher than a longer instrument, the curve has been inverted. And if the curve is inverted, that means there might be a recession. So remember, one more time, right? 2-year Treasury yield top data, inversion that could signal a recession. Yeah, so I've covered Shiller PE ratio, Buffett indicator, and then inverted yield curve, right? But that's not the end. Now, before I wrap it up with these 3 indicators, I want to tell you a story. Right? Many years ago, right, in my 20s, right now I'm already 50, right? In my 20s, I studied my honors degree, right, in Faculty of Science. Yeah, so I was doing zoology. And then for 1 year, I've been working in a laboratory. Yeah, so in science faculty, there are many laboratories. And I have one friend, this is a real story, by the way, but I don't want to mention his name. Yeah, but once I talk about instrument experiment, he will know. So each of us is supposed to do some kind of scientific research, right? Mine is on fishes. Yeah, my thesis is on fishes, right? He's on birds. Serious, no joke. So he's on birds, right? So what he did was he wanted to find, is there any correlation, right, between the wings, the size of the wing, yeah, of a crow, you know, crow, size of wing of crow, right, versus the external parasite. You know, birds actually has parasites, so it's not a good thing. Yeah, so one more time, right, his experiment is to see whether is there any relationship, correlation between the length of the wing, right, and the number of parasites over the body. Yeah, so I find, even if we found it, I think it's a ridiculous experiment. I mean, so what, right? Who cares about the wing of the crow, right? So what he did was he wanted to catch the crow before he can do the experiment, but unfortunately the crow was very smart. Yeah, so he went to Chinatown, right, some places where he put some food, and then he put a drug in the food, so he sprinkled the food. Yeah, and then the crow really came. So once the first crow has eaten the food, right, and then it collapsed, the remaining crow will fly away. So my friend ate the food, died already. So they all fly away. So they know that the food is poison. Yeah. So after that, he realized that he cannot do the experiment on the crow. So he decided to change another species of bird. So Singapore got pigeon, right? Yeah. So he go to the same place. So again, he sprinkled the drug food, and then the pigeons came. Yeah. So pigeon, very interesting. Yeah. Pigeons, one pigeon eat the food, collapse. The friends of the pigeon continue to eat. Wow, the story was quite funny. So the conclusion, other than his experiment, is pigeons are not very smart. That's why in Hong Kong, right, they sell roasted pigeon because it's easier to catch. You don't see that roasted crow, right? No, sorry, this is just my own conclusion. Now, so he instead of the wingspan of the pigeon, he do the wingspan of the pigeon and then correlation with the parasite. So he spent 1 year in the laboratory taking the pigeon, spread out wings, measure, count the number of parasites, throw the pigeon back in, take another one. So he do this. In short, in summary, he spent 1 year, right? And then the conclusion, and then he wrote a scientific paper. It came out in some scientific journal. So the conclusion is right, the length of the wing of the pigeon, right, has nothing to do with the number of ectoparasites. Yeah, so that was the conclusion. Yeah, so that is his conclusion for the papers. So my conclusion of his conclusion, right, is actually the paper a bit useless. Now, why do I tell you this? Now, we have to be very careful about these three indicators. Now, what do I mean by this? Yeah, I'll tell you another story, right? Let's say Cayden is sitting in his, let's say, study room doing investing. And then every time when he saw a stock market collapse, two elephants, right, will walk past the window. Okay? Then the second time when he saw the stock market collapse, then the same two elephants walk past the window. And then every time collapse, 10 times, collect 10 times, right? The same two elephants walk past. So in other words, it looks something like this. Cayden has observed that every time, right, when the stock market collapses, the two elephants, right, will walk past the window. Okay? But that does not mean or imply, right, when the same two elephants walk past the window, the stock market will collapse. Now, I'm going to leave this slide over here to let you ponder through, right? Yeah, I need you to digest this. Yeah. Remember, when the Shiller PE ratio is high, it happens that there's a recession. So this recession is like the two elephants. When the Buffett indicator is high, it's happened at the recession. Yeah. And then when the yield curve is inverted, it happens there's a recession. But it does not mean that the recession is caused by the high Shiller PE ratio or the recession is caused by a high Buffett indicator and so on. So we have to be very careful about this. So remember, indicators are just indicators. They are giving you some feel, right, that it might happen, or maybe give you some probability, there's a high chance that it may happen. But remember, there's always a chance that it may not happen. Okay? But let's assume that the indicators are so accurate that it will happen. And even if without this indicator, if there's a recession or whatever is coming, right, how should you prepare yourself for it? Now, assuming that, let's say tonight there's a recession and the stock market collapsed by 50%, you cannot like, how I want to invest. No. Now that I start saving. Recession, then today start saving. Then today start pick stock, it's too late already. Or then some people may go and watch Cayden's YouTube. Wow, too late already. What crap is this? Yeah, so the key thing is, I hope that I'm wrong about the indicator, but I also wish that I'm right. Yeah, so Wendy actually has posted something. Correlation doesn't mean there's a cause-effect relation. That's a good way of putting it. I think I talk too much. I think yours is a better sentence. Yeah, so let's come back to here, right? Now, let's play a game. Let's play a game. Now, assuming that recession happens tonight, and this is one piece of information that you see. So now my question to you, yeah, correct. You see, Betty is PhD. Yeah, so she said that correlation doesn't equal to causation. You see, that's the difference between PhD and a non-PhD. Non-PhD had to use things like elephant. Okay, so now you look at this diagram. Can you tell me what do you observe? What do you observe? Okay, maybe I give you some tip. The tip is this. At the bottom, right, these are recession. Can you see? Recession, Kennedy, credit crunch, oil crisis. So in other words, all this dotted line, right, are showing that there's a recession. And do you know that when there's a recession, you see the share price drop, right? Okay, recession, right? Yeah. So I'm going to give you 5 seconds to ponder through this. And my intention of asking you this question, maybe I paraphrase my question. My question will be, what opportunities do you see? One more time. What opportunities do you see? So I need your help to just type in the chat box, right? What opportunities do you see? Now, this question is very important, right? Because most people see nothing. Nothing. Now, if you are able to answer this question, and today is a recession, right? Then you will see opportunity. If you have trouble trying to decipher what Cayden is talking about, then everyday recession also no use. Okay, Yeah, so I give you 5 seconds, right? What opportunity do you see in this diagram? Whenever there's a recession, something will happen. Whenever, crisis, war, whatever, something will happen. Okay, so I let you type in the chat box, right? Because there's usually a delayed response, right? Now, maybe I wait for a few seconds. Wait for some people to type. Wow, there are 240 people watching this. Very good, right? Okay, maybe I just move forward while you're typing, right? Warren Buffett once said there is no way you can bet against America and win. Yeah. So Direct say long-term trends going up. Dip is temporary. Buy cheap. Larry say buy cheap. What else? All the bear followed by the bull. Angeline will know because Angeline, you watched the video like 10 times, right? buy more stocks to DCA. Yeah, actually all of you are correct, huh? For every bear, there will be a bull market. Okay, so very good. So all of you are all PhDs. Now, except Cayden only. Cayden, look at the wings of the pigeon. So let's come back to here, right? Now, so what is the thing that I want to say here? Now, do you notice that whenever there's a bear market, which means that the share price collapse, there is always followed by a bull market. And the most interesting thing is, with no exception, whenever there's a bear, this bull is stronger than a bear. This bull is stronger than a bear. This bull is stronger than a bear. And there is no exception. All the bulls are always stronger than the previous bear. And here, right, there is only one direction. And the direction is up. Now, provided that you can ride through the cycles of bear and bull. And the only way that you can ride through the cycles of bear and bull is to know beforehand, right? Whenever there's a bear, every 6 to 10 years, you will follow by a bull. And the bull will always be higher, more stronger than the bear. So in other words, the recession is a trouble, right? But the stronger bull is an opportunity. Okay, huh? Right. Yeah. So registration right now is open, and I'm just, while the link is over there, right? Let me just summarize what we have covered today, huh? Now, today we have covered this company called Netflix. Based on Guru Focus, undervalued. Based on Morningstar, is overvalued. So there's a bit of conflict, right? But from our perspective, the company is still overvalued. Overvalued. So this is a quick wrap up, huh? So that is the part one, right? Before the break, we talk about Netflix. So like I say, during the inside our portal, right, we have 29 companies, much more superior than the Netflix. Yeah, so instead of waiting, right, like Mr. Bean, you have access to the companies tonight. And then here, the next part, we talk about the recession, right, impending recession. And then we gave 3 indicators: Shiller PE Ratio, Buffett Indicator, as well as the inverted yield curve. And all these, right, points to one direction. So remember, is the stock market by crash. Now, bearing in mind that all these indicators, like just now what Betty was saying, right, is it's not a causation, right? Yeah, it's not a causation, huh? Okay, it's just a correlation, right? But it's not a cause-effect relationship, huh? Yeah. But I like these 3 indicators, Yeah, I'll keep this in mind. And whether eventually will recession come through, I'm always prepared with the cash, with the basket of stocks that we can all invest. And then when the time comes, we are going to invest as a group. Together with Avengers and Just Daily. Okay? So with that, okay, there's one comment, right? Gain immediate access to our bonus gathering in upcoming. Yeah, so with that, I'm just going to put maybe a 15 minutes timer, right? And I'm going to flash to the last slide. So the next 15 minutes is just for you to register into our US case study project, and also to let you know that this video will be permanently here, right? In case you want to do a quick recap, you want to pass this link to a friend to watch, whether there's a crisis or not. So these are real life scientific information for you, right? So I'm just going to leave at this last slide. And this last slide is our logo. And just to let you know that we are called VIA, Value Investing Academy, and our mission is we care to make you a better investor, which is why we are providing all this information. Okay, so my team members say I cannot talk already. Oh, cannot talk. So the link is over there. Now, just click on the link, register for our case study or our masterclass, and I shall see you soon. Just to let you know that thanks for joining us, our deep dive again for this evening. And just remember, we are VIA, Value Investing Academy, and we care to make you a better investor. So have a good rest, and I shall see you soon. Okay, goodbye.